What a mammoth global rally we're witnessing here. It seems as though a lot of the positive sentiment really came about yesterday after the weak ISM manufacturing print in the U.S. And I wonder if this means we are now in a bad data is good paradigm.
You know, it's so interesting that you say that because it's not surprising that you would see some bad data be good. The U.S. economy has been relatively strong, despite the market signaling that it's going to get weaker. Excuse me. And so the market is certainly looking forward and pricing in a weaker economy, possibly even a recession, knowing that what the Fed is doing is trying to induce that. But employment in the U.S. has been very, very strong. The unemployment rate is 3.5%. That is signaling to everyone a recession is pretty far away. And so we've been battling or seesawing between is a recession near or not with that unemployment data. But other data clearly is showing signs that the economy is weakening. The ISM data, we're also seeing business inventories falling as well. So I do think the impact is real. Housing is also clearly in a downward cycle. The U.S. is softening. It is having an impact. The market's pricing in something far worse, though, than what we have today.
So, Anne, does that mean that you are adding to U.S. equity positions at this point?
You know, I do think, I really believe what we've seen over the last 3 quarters has been like a storm, and every storm runs out of rain at some point. The trick is really not to get too excited and buy on every day with really, really strong up moves. You have to look at volatility as your friend, not your enemy. And when there's a lot of fear in the market, that's when you need to kind of take advantage of select stocks, companies that you want to own when the rain does dry up and throughout the next cycle, because there will be companies that survive this new higher rate, probably still higher inflationary environment, and certain companies will fare better than others. We haven't seen bankruptcies in a very, very long time, and I think we will see bankruptcies over the next 10 years on a much more frequent level than we did in the past. That doesn't mean that the stronger companies will continue to outperform and generate really good returns for investors.